Good morning, everybody. Bore da, and welcome to this morning's webinar. Just going to go through some housekeeping as we wait for everybody to come on. Just to remind you, this morning's webinar on identifying risks for exporters is going to be recorded and uploaded to the Business Wales Export Zone. If you can have your chat function open on Zoom, this will allow you to post any questions, but also see the questions being posted, and also for you to see some of the answers that we give in if they can't be discussed during the webinar. We will try to hand over answer as many questions as we can during the webinar, but if not, we will follow up with any questions you may have. I'm pleased this morning that we have Tony Agarwal from Kinetic Cubed to do this presentation. Tony's worked with us on exports for a number of years. And I'll hand over to Tony now, who will take you through the agenda and introduce himself as well. Thank you.
Thank you, Paul. A pleasure to be here. So let's just go to 2 more slides, please. Okay, format of session today. So I'm Tony Agarwal. I've been working with Welsh Government for many years. I know quite a number of you on this webinar. Very pleased to be here speaking to you about managing risks. It's something that I'm very familiar with myself. As Paul has just indicated, please ask your questions, use the chat box function. And then at midday today, we're going to move over to have a Brexit bulletin. Hopefully we will have something to say. I was watching the news last night and things weren't quite so clear from our friends at Strong and Heard. So let's move on next. So this morning we're going to discuss identifying and managing risk. Next. So Kinetic Cubed, who are we? As Paul's just said, we're a provider of services, export services to Welsh Government. Been working with Welsh Government for over 20 years. And just in the last decade alone, we've helped over 500 companies. Next. So me, who am I? Why am I speaking to you about this topic? Since university, I've been involved in business development all my working life. In my early years after university, I was doing exactly what you do, which is making things and selling them. Some of those things I was exporting. I didn't have the benefit, I have to say, of being educated or guided in terms of business, less so with exports, and I'm not proud to say, but I've made quite a number of mistakes which I've learned from, and some of those I've been sharing with my clients ever since last 25 years in international business, exporting, finding partners, the last 20 years helping Welsh businesses to export. Next. Okay, so what we're going to discuss today, managing risks, understanding those risks. What are those risks? And risks can be within your control and beyond your control. So just trying to understand what sorts of risks fall into which of those 2 categories. Now, of course, all of us are familiar with risks. We deal with them every single day. We deal with them in terms of our suppliers, our buyers, our people, our HR, our workforce, the premises we have. We deal with risks every single day, every single hour, every single minute. What makes exporting risk different to normal business risk is that there is another added layer of complexity, so many more unknowns, which vary by market. You have a good idea what those risks are at home, but even those can catch you unaware. But imagine sort of multiplying that out by many more factors. Remember, fundamentally, when we talk about risk really means money. That's what it means. That's the bottom line. Risk equals money. So you have to be very careful. We are talking about business risk. If you get it wrong, you're going to lose money. You might find yourself out of business. So very important to know what those risks are and ways of managing that. So you can't overcome all risks, but you can do your best to mitigate some of those risks. So let's start to dive into some detail next. The agenda. So today we're going to talk about risks within your control. So these, broadly speaking, are customers and delivery risks, documentation risks, payment risks, and risks outside of your control, losses, things that happen, foreign exchange, force majeure. Okay. All of these risks ultimately concern the failure of being paid. And remember, a sale without payments is vanity. But within getting paid, you also need to make a profit. So it's about making sure you make a profit and get paid. Managing risk costs money. So how do you decide how much money you're going to spend on managing those risks? As you're all very well aware, the cost of recovering bad debts can be quite costly, if you'll pardon the pun. That's in the UK, and there are many ways of doing that. There are many agencies to help you, but doing that in an overseas environment is much more complicated, and it is the risk of not being paid, because as I keep saying, risk is payments. It is that risk of not being paid which puts off many would-be exporters. So this session today is really quite important. It is a major hurdle to overcome. Next. So let's start by, we're going to spend most of the session talking about risks within your control. And there's an obvious reason for that. It's within your control. So let's talk about the things you can control. So customers, they can perhaps default on payments, or you can find yourself in a situation whereby the documents that you need to stimulate to trigger payments can be faulty. There's an error somewhere. The fundamental impact of either of those scenarios is non-payment, which is a disaster. Next. Within your control, things like you can do by being a more observant of the requirements is understanding the contractual documentation requirements. It's a given that you satisfy regulatory requirements, as it's legal for you to sell something somewhere, and of course that the quality is acceptable so that it's not rejected. So fundamentally, the issue here is, if there is a problem, who is responsible? And this is why you need to be vigilant in this particular area. If things go wrong, whose laws apply? And not only might you find yourself facing the issue of non-payments, but that could be worse still. You could actually find yourself being pursued for claims for consequential losses as well. So this thing can mushroom out of control if you're not careful. But when it comes to contractual and documentation, these are things which you have to be careful of. And again, they're a little different to the concept of any contract you'd sign when hiring people, when buying inputs, when selling things. So look at the terms and details. And now let's dive into a little bit more detail on these. So next, customer/delivery risk. The banks have a policy, which I'm sure you're familiar with, which is know your customer. And the same goes for us as exporters. Know your customer, get to know who they are. It takes time to build that knowledge, develop a relationship. That's an incremental process. This is particularly critical if you're offering terms to them where you're taking a risk on, are they credit worthy? So for customers who you don't know or will never get to know because of one-off sales, I'd say to you, always demand payments upfront in advance. Maybe you offer a discount as an incentive to stimulate that payment in advance. But the fundamental principle with business, with everything I'd say, is never take a risk like you can't afford. If it goes wrong, make sure that it's not going to kill your business. We've seen examples where these things happen, and it's sad to see a business which is in growth stage actually falter on its journey because it was let down somewhere on the journey. So let's talk about delivery. Let's talk about contractual risks to start with. Next, please. Next slide. Okay. contractual. So language of contract. So what language is this going to be in? Obviously, you'd want the contract to be in English if you can, but it's very much driven by the customer. If the customer is a big government organisation, let's say a German or a Japanese client, they can demand that the contract is in their terms. So that gets very difficult and messy, which is why, unsurprisingly, most SMEs are exporting to clients where the contractual language is in English. A big area to, one key line you must always look at in a contract is which laws of the land apply to that contract. Is it the law of the seller or the buyer? The buyer often prefers that the laws applied, it is their local laws that apply, or it could possibly be a third-party country as well. What is a method of arbitration if things go wrong? Again, some detail, easy to ignore and hope isn't a problem, but something to be aware of. And ultimately, who's going to pay the legal fees? So the initial set of legal fees is for drawing up the contract, and then legal fees in the event of things going wrong. Remember, legal fees can be very, very expensive, can rack up very quickly. So what can you do to try and minimize those costs? How can you make it simple and clean? And certainly a point I make to companies who are either setting up overseas or are dealing in something which, if it goes wrong, can threaten their very survival. So my question is, can you ring fence your business? By which I mean you introduce a new entity, you create a new entity, which is the exporting party. So you sell your goods from Wales to an entity, a separate standalone entity in the overseas market, who then sells to that customer. So in the event of something going wrong, it is that entity which would be liable for any claims that might occur. So that may work, it may not work. You'd have to seek legal advice, and it may be that the customer refuses to accept that new third party. Next. Documentation risks. The very first question is it legal? Very, very important. You think things are legal, but not always so. First things first, make sure HMRC know what it is you're exporting, particularly if it's for goods, because goods, with goods you have an issue of VAT. If you cannot prove that the goods have left the UK, you are liable for VAT. But perhaps the most important point on this slide is the export controls. If your goods can be used for military purposes or can be used for military and civilian uses, but could possibly, could obviously be redirected for military use, and they are banned, you can find yourself in very big trouble. Remember, the directors and owners of a company are liable. They can actually end up going to prison. I remind you of the example of Churchill Matrix back in the 90s, which sold some big pipes, which arguably could be used for guns in Iraq. The directors ended up going to prison. Then there's another aspect to consider is when shipping goods, are the goods dangerous because of the safety of life at sea? So what you're sending, is it safe, is it hazardous, or is it hazardous? And if it is hazardous, how is it to be shipped? Now, I appreciate many of you on this call are selling services. After all, most of our exports are services. So some of these things don't apply in the same manner. So in this scenario, for a service provider, the question would be, are your services recognised? Are you allowed to sell your services into that country? Are your qualifications recognised, for example? And how is data held? So these are other considerations for service providers. Next. Documentation risks. I've mentioned HMRC, but when shipping goods, you do need to be declaring to HMRC using the online system Chief, which is on the website, which is on the slide, and you need to have a EORI number as well, which you can guess. Also, you will need, if exporting goods, you'll need to have a commodity code or a HS number. Very, very important. Don't be sloppy on this. Don't guess. Don't go for a nearby code. Make sure it is completely the right code for your products. Do not pass on the liability to somebody else or ask somebody else to be responsible. Ultimately, you are responsible. You're the one held legally responsible. You cannot blame a freight forwarder, okay? There's a website there to help you in terms of how to find your tariff codes. And as of the 1st of January, you will need to have the paperwork in place for exporting to the European Union, because we will be a third party to the European Union, okay? Next. So, sorry, let me just get my way, okay. So, delivery terms. This is where some of you may have heard of Incoterms, customer and delivery risk. Incoterms comes into play. So, Incoterms are widely used. They are universal, the universal language of business for shipping goods. This is a terminology which defines who carries the risk of what up until what point. Absolutely critical. This is a negotiation when you're selling or buying if you're an importer. It helps define who is responsible to what point, okay? Very, very important. So let's just go on to give you a brief summary of Incoterms. Next slide, please. So here you go. You'll see the spectrum. Green is where you, the seller, carry the risk. Blue is where the buyer carries that risk. You can see the slope there. So where you have the least amount of risk is the very top one. X works, where you make the products. Obviously, you'd want advance payments or payments against documents there, but fundamentally it's X works, and from that moment on, the buyer picks up the goods from your factory, and they carry responsibility thereafter. At the opposite end of the spectrum is a delivery duty paid, whereby you carry the risk for almost everything, including the tariffs that might be applied, which could change. So this is something we're finding that European Union customers are more likely to insist upon from the 1st of January because of the uncertainty. Now, you'll find yourself anywhere along that spectrum line, and again, this is a negotiation. So obviously you want to try and minimize your risk, so try and go as high up as you can on this listing, but that may not always be possible. It depends upon who has the power. Next, please. Now, this is perhaps the biggest area of concern for many of you, is payment risks, particularly in a scenario where you have open accounts. I'd say that you would only go to open accounts after you've already had some transactions with a customer to give you that feeling of confidence. So it's not something you would normally offer immediately. So to offer an open account, you need to assess their credit worthiness, which is easier said than done. In the UK, we have many ways of assessing creditworthiness. You can go to your bank. There are many providers of creditworthiness records, such as Experian, Dun & Bradstreet. So many ways, and Companies House is a good starting point as well. That same scenario does not apply in all markets, and even where they do have such mechanisms, it doesn't mean to say that those mechanisms are as robust and have the same veracity like you're accustomed to here. So as a result, assessing creditworthiness in an overseas customer becomes more complicated, and that gets magnified because that risk, that creditworthiness can include the country risk as well. So assessing creditworthiness for an overseas sale opportunity can be very difficult. So try to do all that you can. A good place to start would be going to the British Embassy, but nobody can give you a guarantee. So beware. You would need to take out some sort of private insurance to be on the safe side. Where you do offer an open account, control financial exposure, just as you would do for any client you have in the UK. So giving them certain amounts of credit, extending certain amounts of credit limits, and make sure that those limits are reviewed periodically. And I would urge you when selling overseas to make sure that you're not building up the amounts of credit that's owed. So make sure that they pay bills before you release any more goods. So again, it goes back to setting those limits and living within those limits. Don't be sloppy. Sloppiness costs money, can cost businesses. Next. So here's some alternatives, particularly in the early days. There are various ways of securitizing payments against orders. I'll talk about this in a second, but let me just talk about the most obvious ways to avoid some of those documentary ways. Number one is obviously payment in advance if you can, not always easy. Number two is sell via an intermediary. So that could be as an indirect export to a party in the UK, so your claim is against them. Alternatively, it could be against an intermediary in the overseas market who you know and trust, because the end customer is less likely to mess around with somebody that they're buying from in their own market. They know that they have greater scope for playing the game if they are buying from an overseas party, because they know that the cost of pursuing that claim can be horrendous. So those are the first two ways, payments in advance, sell via an intermediary, but in the absence of that, securitization is the way forward. So let me just walk you through some of these ways of doing that. So documentary credits, for those of you who are not in the finance arena, it's a means of payments and the bank guarantee that protects the supplier and buyer and forces both parties to fulfill their commitments. So you, the seller, provide the products, whatever it is you're meant to provide, and then payment is released against that, against handing those goods over. So it works for those making products. Letters of credit, it's a bit like a documentary credit, but the risk is much lower. You'll get your payments for sure against the documentary credit. And then there's something which is a little bit of an in-between, which is a letter of credit standby. It's a bank guarantee, it's not a payment. So only in the event of non-payment will you be able to claim back from the bank the payment, but that will take time and cost money. All of these instruments are dependent upon banks on both sides. Your own bank now, I'd say to you that in the UK, our banking system is highly concentrated. In overseas markets, there can be a plethora of banks. In India alone, there'll be hundreds and hundreds of banks. And many of those banks will be banks unbeknown to us, where your own bank, the correspondent bank, your bank will be working with a correspondent bank, and that correspondent bank overseas must be a bank that your bank feels comfortable with in terms of their processes and feels are going to honour their obligations. And you may find that in some cases, the correspondent bank just doesn't meet those requirements. So these things are not easy. And finally, I must tell you, very many letters of credit are rejected before exporting even begins because of inconsistencies and inaccuracies. But even when the goods are shipped, it is possible sometimes to find errors and holes in the LC, which might create wriggle room in the event of settlement. So these things are not guaranteed or perfect by any stretch. Next, please. In terms of actually financing the sale or financing the working capital, obviously you can go to your bank to extend your working capital facility, or until such time as you've paid. An alternative is forfeiting. It's factoring for export sales, basically. So there are companies in the UK who specialise in forfeiting, whereby upon presentation of documents like you shipped out the goods, etc., they will give you payments, having taken their commission, their cut. However, if the customer then defaults paying The forfeiting company, then the forfeiting company will come back to you looking for repayment of any advance they've given you, plus interest and costs. So it can lead to a very uncomfortable position, which is why you need to make sure your customer is still credit worthy. All that forfeiting does for you is provide you, it's a means of providing you working capital, really. Okay. Obviously, you can insure the receivables, and that all comes as a cost. And these things are all available in the commercial market. As I say, they come as a cost, and the greater the perceived risk, the higher the fee like you should expect to pay. Now, there is another way forward, particularly for those selling more complex products and services which don't neatly fit into a nice clean sale whereby you sell a box and that is it. What if you're selling components into a bigger project where there are very many suppliers, for example? It's not clean. If one party in that supply chain fails in any way, what does that impact? How does that impact upon you? Do you still get paid? It gets very murky, very messy. So let's talk about something which will be of relevance to a number of you on this call, I know, because you're very much in that sort of engineering project-based space. Next, please. UK export finance, of which many of you should be very familiar because Wales has a superb UK export finance business development manager who WG can introduce you to when the time is right. So what is UK export finance? The mission is to ensure that no viable UK export fails for lack of finance or insurance while operating at no net cost to the taxpayer. A very key word which many of you will have spotted there is viable. What is viable? That's why the people at UK Export Finance will need to understand what it is you're trying to do to assess what this is about. UK Export Finance works with the private sector who will fundamentally be providing the finance for whatever it is you're looking to export. But fundamentally, UK Export Finance will be underwriting some of this in the event of some failing. And UK Export Finance is really critical to help win those difficult, complex contracts. You will need, in some cases, if you're tendering for big things, to be able to say, we have the finance and it is underwritten by a third party. And UK Export Finance could well be that body. It can help you with providing working capital when you go to your bank, for example, asking for working capital. The fact that UKEF are behind that will help you. And it'll also help you in terms of any insurance like you might be seeking to get. So very important body. And you can see the significance in the last 5 years, they provided £14 billion of export finance support. So what does this mean in real life? So let me give you an example from Wales next. This is in the public domain, it's on the website. This is for a company many of you may be familiar with by the name of Carpenter and Patterson. They're based in Wales. They're looking at a big project in India with a very reputable company. I must say Reliance Industries, one of the biggest companies in India in the oil and gas sector with a refinery. So on the face of it, as I look at this, Reliance Industries, sure, well-known company, your bank ought to be willing to provide finance. However, supplying some part of a big £300 million project gets very messy. If you're just a tier 2, tier 3 or below supplier, you're not the prime, then how does a bank feel comfortable with that? And very often banks don't feel comfortable. It's too messy, it's too murky to understand. And this is exactly an ideal place for UK Export Finance to operate and support those big complex orders. And as we can see at the end here, so UK Export Finance helped provide the security that was needed. It generated $9 million of revenue for C&P over 2 years. And in markets which are difficult to get that sort of cover from. That business was worth, according to the managing director, it generated growth of 50% of revenues, and that would not have happened without UK Export Finance. So for those of you, of which are very many in Wales, operating in that sort of project environment, UKEF are very important to consider. So that's about finance, which is clearly a critical part of managing risk. But let's now move on next on to risk beyond your control. How do you protect the unknown? Very, very difficult. Things which are beyond your control. So let's have a look at what is beyond your control. Losses. Things can just happen. They do. We heard in the news yesterday that the ports are experiencing problems. There can be delays. Goods can get lost or damaged or stolen in transit, as happened to me with my shipments. So what to do? That's not your doing. Things happen. Ships sink. Trucks have accidents. Things happen. Then there are political risks, which ultimately mean currency risks. And there's this lovely French term, force majeure, which is a lovely term which many of us don't often understand, but perhaps came to life in more ways than one this year with COVID. Fundamentally, all those risks impact upon your ability to fulfill a contract. If you can't fulfill your contract, what happens next? Who suffers the pain? You may not be paid. Your client may not be able to buy. They might not be able to pay even if they've taken delivery. So it's a very, very difficult, complex area. So let's look at these individually next. So losses, as I say, they can happen through nobody's fault. It's important to know who would be responsible in the event of something happening, delays, non-delivery, etc. And this is where insurance comes into play, where you can get yourselves covered for this. Marine insurance typically is what you would need. Very important. After the loss I mentioned, as I had myself, I then started to have a policy which included marine insurance, having learned from that very same mistake. But this is also a place where Incoterms come into play. Apologies, there's an error on the spelling there. Incoterms, that's the slide I showed you where you got the various risks and the various terms of trade, because that will help define who is responsible. So this is where you need to make sure you understand the impacts of Incoterms. Next, foreign exchange risk. This is foreign exchange is, we talk about currencies going up and down all the time, and that's because of economic and political factors, some of which one can predict and some of which you cannot predict. Okay, so when you're selling to a customer whose currency is different to yours, and for us that would be everybody else, you can either sell in your currency, so they are buying in pounds, or you can sell in a different currency, a neutral currency, a well-known, well-traded currency like dollars or euros. And so in that case, it is the customer, or if you're an importer, the supplier, they carry that risk. Okay. Sorry, the customer carries the risk if it's in their currency. Sorry. You carry the risk if it's in their currency. You don't carry the risk if it's in sterling. So you can offset your sales with purchases. So if you're buying in that currency as well, but you're buying in dollars, selling dollars to try and manage those sums of money. I strongly urge that if you can, be in control of the currency conversion. Don't let the bank make those conversions when the money lands into your account. It'll be at an invisible rate, something you do not control, and it will be, I tell you, it will be at a higher commission rate than you would do separately. So as a company, we ourselves, as an exporter, we have our own foreign currency accounts for the markets we export to, and then we convert using a third party compared to and not using our own bank, who charges a higher rate. Another option is to agree an advance rate for some time when you're expecting payments. That comes as a fee. It's basically the futures market forward buying. It comes, as I say, as a fee, and the longer that period, like you're waiting for a year, 10 years, 5 years, whatever it might be, the greater the risk, and therefore the greater the fee that's going to be charged, which is often expressed as a spread. Just to give you a feel for the impact of foreign exchange, let me give you an indication on the next slide. So foreign exchange fluctuations. So many of you may be, if you cast your mind back to June 2016, there was an event with the impact happening on 24th of June. I won't tell you what the event is because you should be very familiar with this, but what happens in this scenario? So the chart you're looking at is for a trading day, okay? It's not for days, it's one trading day. And you can see that the average difference is 8.4%, which is phenomenal. On a normal day, you might see fluctuations of 0.1, 2-3 basis points, which is 0.00, 1 or 2, 3, whatever it might be. But sometimes for some currencies, you might see changes of 1 or 2% in a day. That can happen as well. In this case, it was 8.4%. So who shoulders the loss? It just depends. So if you're going back to the point, if you're a seller selling in pounds and you're due to be paid on 24th of June, there, you'll feel no impact, okay? But the buyer actually gains by 8.4% because they need fewer dollars to buy pounds, okay? If you're if we flip this around, then it's going to be the opposite way around. So if you're it's very complicated, this, forgive me. If you're selling in euro or dollars in this scenario, you're going to find that those dollars will buy you more pounds, so you would actually gain. So it really is a bit like going to a casino. So trying to understand the impact of foreign exchange on your margins is very, very important. As I say, typically you'd have changes of less than 1% in a day, probably a few basis points if that, but something to be aware of. Next. Control, this is a force majeure risk. These are things that happen which are completely beyond your control, things like nobody could anticipate, things like civil war, nature impacts, earthquakes, flooding, hurricanes, diseases, fires. And until this year, you probably would have been not so conscious of this risk. COVID-19 has changed everything, your ability to travel. So for example, if you're a service provider meant to deliver in market, you wouldn't be able to travel. Your clients might not be able to honour their obligations in terms of the orders that they place with you. So this can have a huge impact. It can cancel the actual trade transactions. So who is responsible in this scenario? And in this scenario, it can get worse when you're dealing with a national, when you're dealing with governments, because they can rightly argue that everything has changed beyond their control and there's very little that can be done. So these are things you need to be conscious of, which takes me to the next slide, which are the solutions. So insurance, you can insure for everything. You can bet on everything, you can insure for everything. And I'd remind you that the UK marketplace for insurance is the most sophisticated in the world. Think back to the famous coffee shops in London in the 17th century where people were doing things, were trading, and the insurance industry came out of that, Lloyd's of London. So you can get insurance for almost everything. You can get cover for credit risk, cover for political risk. You've got maritime shipping risks as well. You can cover for everything, but do be aware that insurance costs money and there's only so much margin you have to play with. So you can insure for everything, but in so doing, you might find yourself not making any profits at all. Remember my saying, profits are sanity, turnover is vanity, okay? So very important to make sure you're making a profit. Now, clearly, for those of you selling services, this is where it gets somewhat murky in terms of what you can and cannot insure for. Goods are much easier than the tangible, you can show where you're at. With services, it gets much harder to show where you're at in the point of servicing, in the point of selling, exporting. So things are not always easy, which is why you'd be looking for some upfront payments if you can, as a service provider, or working again with an intermediary in market to avoid some of those non-payment risks. And in summary, the key recommendations are: know your customer. So research your markets, visit the country, know your customers, work with local partners, identify all risks. If you're making things, make sure that you make one and have it signed off before you go to trouble making many more. And just check whether the UK has a trade agreement with that country. The UK DIT has been busy entering into a variety of trade agreements in anticipation of the 1st of January. So there are already continuity trade agreements with countries that we had enjoyed trade agreements with via the European Union, like Canada, like Japan. So that will help you, because the trade agreements will help reduce some of those risks. But fundamentally, when it comes to risks, evaluate those strategies to understand those risks, rank those risks. Those risks which are more likely to come into play are the ones you need to perhaps need to insure and to work and to manage very, very more carefully. And then, of course, finally, monitor those risks over time, because those risks will change. What was high risk at one point will change its profile, and something which was low risk will become a higher risk issue as you move along. Managing risks is a really important part of any business. It's something you do every single day with your home market. It just takes on a new meaning when you export. And with that said, I'm going to move over to questions if there are, if you'd like to start the process, Paul. Thank you.
Sorry about that. My on mute. Do you have any questions in the?
I'd like to ask. Nope.
Sorry, I'm giving you too much information, I fear. Perhaps, Paul, whilst we're waiting for questions to come in, I could speak about some of the things I've experienced whilst working with Welsh companies in terms of risks.
Yeah, go on.
Often we find ourselves in a situation where companies have extended credits. I can think of one prominent example of a company selling recycled waste materials from the UK, sending them to India, which is a major centre for recycling. And that they found themselves in a situation where they had an exposure in the hundreds of thousands. And as a result, they needed help to go and try and resolve that issue. So we found ourselves taking that company to meet those customers in some very remote places in India to try and reclaim those lost debts. The challenge we faced there was they had no power. So they were almost on their knees asking, trying to be as nice as they could, asking for the customer to honour their obligations and hearing whatever grievances the buyer had. But they are in a very weak position. We also put that company in contact with recovery agencies in India who would take a hefty fee for whatever they recovered. We're talking about 40–50% of whatever they recovered. The fundamental problem with in that scenario was they shouldn't have offered open accounts. They should have checked things at an early stage. The longer you leave something like this, the worse it gets. So you can find yourself in a situation whereby you're onto hiding for nothing. So for goodness sake, don't just do business on a handshake. Make sure you know, and if you do business on a handshake, even if you don't, make sure that your exposure is minimized. It's something you can live with if it goes wrong, because if you don't, you'll find yourself in a precarious situation.
Okay, thanks, Tony. Has anybody got any questions they would like to post on this morning's presentation? We have got one here, Tony. In your opinion, what would you say is the biggest risk to export as a result of the COVID outbreak?
Gosh, that's a good question. Biggest risk with COVID?
Or what have you seen with the companies you've been working with? What kind of risks keep coming forward for those companies who have been affected by the pandemic?
Oh my golly, their inability to complete their obligations, either as a seller or as a buyer. They've just not been able to fulfill those obligations. Let me give you a personal example. We had a contract to deliver services for a client where we were meant to be delivering in the US in May. We had a contract to sign contract. That event didn't happen. What do we do? Do we go and make a claim against our clients who'd signed the contract for procuring our services? Wasn't worth the trouble. But to come back to your question about what I've seen in Wales, I think in many cases it's been an issue of trying to find some sort of middle ground, a common understanding, and this is where goodwill and my point about knowing your customer or supplier or whatever it might be is critical. Trying to find a way, understanding one another's points of view, and trying to find a way whereby you can carry on. And from my observations, I'd say that although the first 4 to 6 months of COVID were very damaging, if you've got a good relationship and if you hadn't been, if you were understanding, let's say both sides were understanding during that time, we found that in many cases, as business was able to be transacted, people have been able to pick up again from where they left off. But obviously things, timelines have slipped, but just having a common mutual understanding and respect. So things have definitely picked up without a shadow of doubt.
Thanks, Tony. Another question, what are the main risks in providing software and services to foreign clients? Is there anything in addition that can be done to mitigate against these risks?
It depends. We have a similar story, actually, a very similar story for a company from Wales selling software into Canada a couple of years ago. Their software was not for anything which I'd describe as being harmful. It was some software for HR management services, but arguably that could lead to something harmful in extreme circumstances. The client in Canada services North American clients, so US clients as well. So what to do? As we know, litigation is a very big feature in North America. So what to do? There were a number of options available for a Welsh company. They could assume that risk, which in the event of a claim would be the end of that business. They could insist that the risk was with the customer who was selling to many more customers. Or another possibility which we suggested was that they set up, remember I mentioned ring fencing, that they set up a separate entity in North America and Canada. And it would be that entity which, if there was a litigation issue, would be the fall guy. So that would be my suggestion in that case. To the persons asking that question, I'd ask, what is it you're selling? What impact might it have? But you do know you can get insurance because you're a service provider. You can get insurance, professional indemnity insurance and so on to cover that. However, for North America, the costs are prohibitive.
Okay, thanks, Tony. I've got another question. Which do you think would be the major risk in 2021 and force majeure risks of financials due to Brexit?
Okay, so let's have a look at those. What are major risks in 2021? Well, who'd have thought COVID would have happened? If I knew, I would not be giving this webinar, Paul. I would be on a desert island spending all my money, spending loads of money, because I'd have earned so much money if I could see into the future. I don't know is the bottom line, but what I can tell you, which I think is a major risk, not necessarily in 2021, but in this decade, is going to be climate change. Climate change is having a real impact. We've been experiencing that, and I would argue it's only going to get worse. So the risk of floods, hurricanes, and so on. So these are things to definitely build into your planning, into your financial risk management. In terms of risk of force majeure, risk of financial due to Brexit, our next speaker, Andy Baker, is going to tell us some of those. Hopefully might be able to answer some of those. So I'm going to defer to Andy because he might be able to tell us what some of those risks are.
Thanks, Tony. That's a nice segue because I believe Andy's actually joined us now, so we can do the move on to the Brexit bulletin. So thank you.
My pleasure. Thanks.
Hello. Hi, good afternoon, everybody. Obviously, my name is Andy Baker. My previous background is 20 years, well, just short of 20 years in freight forwarding. And I believe Tony and myself are obviously going to discuss Brexit and obviously impact and currently what is happening in terms of January the 1st, what information we've got from government so far, and obviously little risks in terms of Brexit and what is happening. One of the major issues with Brexit, obviously, as you've probably seen in the news the past couple of days, is in terms of capacity. That's one of the major risks that you need to be aware of, is capacity of goods, capacity of shipping, and it's only going to get worse come January. So that's one thing that you need to be aware of. I believe, Tony, you want me to go through obviously a few bullet points in terms of what is going to be happening, the struggles that we are finding. Obviously, myself and yourself were with a colleague a few days ago, and we highlighted they're just one of the issues that obviously them as a business are struggling with, obviously what us as consultants are struggling with, and trying to get information from HMRC, obviously to assist them post-January onwards, it is proving to be quite difficult.
Yes, exactly, Andy. I mean, it's looking increasingly likely that we're going to have no deal. That we're going to have a situation where there's complete uncertainty. So with that in mind, what do businesses need to be prepared for? What should they expect?
Yeah, what should we expect? Right. First major point is, deal or no deal, there will be import and export entries. Yes. So that is one thing that you need to be aware of. If your business imports or your business exports, either way, deal or no deal to the European Union, there will be the requirement for import and export entries, which obviously then builds on cost to your business for obviously arranging them customs entries, additional items on your invoice, so whereby your invoice would obviously be the sale of the goods currently. From January onwards, you are looking at further information, not just obviously commodity codes. You need to make sure your Incoterms is on your invoice. One of the major things is country of origin of the goods. So that needs to be on your commercial invoice. And also any licenses or export or import licenses will need to be on your commercial invoice. In terms of preference documents, there was a release from HMRC a couple of days ago excuse me, in regards to the generalised system of preferences. So obviously if you're exporting to any of them countries that are under the GSP scheme, or you're importing to any of the countries that are in the GSP scheme, then HMRC is keeping the GSP scheme, and there is further information if you want to have a look at that on gov.co.uk. Another thing that obviously Strong and Heard we keep getting asked is preference to the EU, and we've got goods that come into the UK from the EU. We then export them. Do they qualify for preference? One thing I will alleviate on is HMRC and DIT have obviously got the continuity agreements, which I'm sure at some point you all would have come across. They were published earlier in the year, and I believe on the last webinar I went through this as well, Tony, that HMRC in their wisdom have decided to remove the continuity agreements, which isn't very good news for you as a business, and obviously I'm exporting my products. I need to know what information I need to provide to my client in order for them to claim preference. However, as they've been removed for review, we are unaware of if there's going to be any changes. Now, the prime example is the South Korean agreement, whereby an invoice statement is produced both on export from South Korea and on export from the UK going to South Korea. Now, if that's going to change, whether it's going to change to a UK equivalent document, such as a UK equivalent EUR1 that they're going to produce, or whether you're going to be staying as the invoice declaration, we are unaware of. That could change between obviously now and January. Hopefully they will re-release the continuity agreements as soon as possible. I believe this morning there was notice of the Singaporean agreement and an agreement with Vietnam also. A continuity agreement that was released this morning. Again, that's not been published to HMRC onto gov.uk in terms of the whole agreement and the rules of origin and what you as an exporter would need to produce in order to provide any preference documents. So again, that we're currently waiting, and that's one of the big sticking points for you as an exporter and an importer in terms of what do we do to obviously provide this to our clients or for our suppliers to provide us with. So that's one of the hurdles that we're currently unfortunately still sat at. In terms of the invoicing, obviously I've gone over that. That's just one of the major changes really to you as a business. If you're only exporting to the EU, then it's going to be a massive change to you. If you're also exporting to the EU and the rest of the world, then your EU invoices need to be in line with the rest of the world invoices. So there will be changes to you as a business, to your SAP systems or ERP systems, where additional data will need to be entered onto your documentation. One of the other changes which I will alleviate on is all your packaging, your pallets, pallet boxes, for example, will have to be ISPM 15 standard going to the EU, and that's one thing that you need to be aware of. There will be checks on the pallets or the packaging to ensure that it meets the ISPM 15 standards. However, we believe that the checks are not going to be thorough. They're not going to stop every single vehicle going into the EU to obviously check each pallet. But you need to be compliant with that, and that's one of the change that you need to be aware of as a business if you're exporting to the EU or your client is importing to the UK. That you yourselves and obviously your suppliers need to be aware that obviously any packaging, any wooden packaging, needs to be ISPM 15 standard. Okay. I believe, Tony, obviously you wanted to discuss hurdles that we're currently facing.
Yes, I do. But before we go into that, Andy, can I just ask, in the event of a no deal, duties are going to be applicable?
Yeah.
And for those who only exported to the European Union, they may have carried out they may have issued they may have orders pre this possibility. You know, what sort of duties are we talking about? And I guess the question is, who is responsible for those duties? I suspect it may be the seller in this case, but what sorts of duty rates are we looking at typically?
So typically the duty rates that you're looking at for obviously products going into the EU will basically be what is on the current UK global tariff. And that is the third country duty rates. So that unless we get a deal, there will be a huge risk to you as a business that obviously your products will be dutiable within the EU. Now, in terms of who's going to pay that, that's down for yourselves and your clients to obviously discuss that. There's certain businesses that we've dealt with that want to ship under DDP Incoterms, and that causes a real big issue to UK exporters, where they will have to have an EU EORI, and they will have to be VAT registered also in the member state that they're exporting the goods to. Now, bear in mind.
Sorry, can I just pause there for a second, Andy? You mentioned they would have to be VAT registered in the country they're exporting to.
Yeah, correct. So the process will be that if you're not using common transit facility, and let's say your products are going from Dover into Calais, obviously the goods will have to be cleared in the first port of arrival in the EU.
Yes.
So you as a business, if you're selling, let's say DDP to a company, let's say in Italy, for example, and you're not using common transit, okay. You as a business will have to have an EU EORI, and you'll also have to be VAT registered in France to account for that VAT.
Somebody has to account for VAT. Is this not something that a function that the shipping agent, the freight forwarders can cope with, deal with?
They can. I believe the four courier companies, TNT, DHL, FedEx, UPS. I believe they are looking at facilities where they could act as a representative for you. So you wouldn't have to necessarily go down that line, but do speak to your freight forwarders if they have that facility where they will be the importer for you. Then obviously that's something for you to look at and be aware of. However, DDP does provide these difficulties, so that's one thing that you need to be aware of. You need to look at your Incoterms currently, and your supply chain currently, and if they need to be changed for any reason, then that's something that you need to be aware of. And obviously DDP is well, DDP and X-Works are both considered from January onwards to EU movements to be a bit of a sticking point. So
okay, thank you. So sorry, Andy, you're going to talk about some of the, you also touched upon the challenges businesses are facing because the information simply is not there. So we see the adverts to be prepared, but you can't always be prepared if there's no guidance, there's no instructions.
No, correct, Tony. So currently we're waiting on a lot of guidance from HMRC. Certainly if you are exported to Northern Ireland, for example, there's still a lot of guidance that needs to be released from HMRC. In terms of what I've discussed regarding having a VAT registration in the EU, that is not actually published on HMRC at all. Yes. On gov.uk, that's not even mentioned. The only way really for you to have known that is obviously to go through the regulations and rulings, which really should be published from the government pretty much straight away. All that was published from the government was, if you're exporting to the EU, you might need an EU EURI. It didn't actually alleviate on Incoterms, and it didn't actually alleviate on any VAT rulings either, Tony. So.
Oh dear. Okay, so lots of questions. I'm conscious of the fact that we are entering the festive period where things are, it's difficult to get hold of people, and there are all these uncertainties, and everything takes effect on the 1st of January. Where does this leave business with transactions in the new year?
Good question, Tony. Very good question. So for any transactions that are currently done, or shipments that are currently booked to leave before January, there is good news, whereby providing you can obviously prove to French customs, for example, that the goods have left the UK before January, then your goods are free to enter the European Union without any duty or VAT applicable. And the same rule applies for any imports into the UK. So obviously, if your goods are leaving just before Christmas, for example, or they're collected just before Christmas, but they don't actually arrive until, let's say, the 1st or the 2nd of January, then again, providing you as a business can prove to Border Force that obviously the goods have left prior to them dates, then obviously there's no duty or VAT applicable. Where it leaves us in terms of shipments from January onwards, it leaves us in quite a difficult situation, whereby businesses, I would say the majority probably feel that they're not prepared, or there's not enough guidance, Tony, from HMRC. There is limited information coming from HMRC, apart from obviously the basics. There is the border operations model, which if you haven't read, I would recommend that between now and the 1st of January, you have a read through the border operations model, and that's available on the government website. And that will go through the total border procedures of what you would need to do in terms of both your imports and your exports. Another thing I'd like to alleviate on is one of the easements is postponed VAT accounting. Now, if you are unaware of postponed VAT accounting and what that is, I can briefly go through that with you. So postponed VAT accounting is whereby for shipments on import to the UK, you don't physically pay any VAT on import. What you would need to do as a business, you don't need to register for postponed VAT accounting. It's available for every single VAT registered importer. And what you need to do is you would instruct your freight agent or your customs agent or your freight forwarder that you wish to clear the goods under postponed VAT accounting. And what they will do is, on the customs entry, is they will enter a little code under the VAT box, which was a G for golf. So for your instructions, you obviously just advise them that the method of payment would be G, and obviously advise them that you wish to use postponed VAT accounting. And that's really it. In terms of the actual process regarding the C79 that you'd normally have on import, well, the C79 under postponed VAT accounting is not applicable anymore. What you would do as a business is you need to register for what's known as CDS, so that's Charlie Delta Sierra, and that is on the government gateway. So you'd log into your government gateway account and you'd register for CDS on there. And the new system for postponed VAT accounting is called the MPIVS, and it's all electronically done. It's not a paper document, just like your C79 certificate. So you would access that via your government gateway account. I currently believe that the CDS is not online yet, so you can't actually go into your government gateway and apply it to your account yet. However, it will be live and available I believe shortly, for importers to add that onto their government gateway. And basically you account for the VAT on there. You don't physically pay VAT on imports. So that is one of the easements that HMRC have released that will enable you. It's more of a cash flow easement, because obviously the government will want you to pay VAT at some point. And obviously it's then VAT is then paid once the goods are then sold. However, it is a cash flow benefit to you as a business. So if you've not looked into postponed VAT accounting, please do so. There is further information on the government website. There is also further information, I believe, due on CDS on what boxes and what information you would need to produce. But that's currently not up on gov.uk yet.
Okay, can I ask you also about country of origin for those exporters who've only ever exported to the European Union? How will they prove the country of origin?
Yeah, that's a good question, Tony. So your country of origin, obviously we were still in line with the WTO rulings for non-preferential rules of origin. Unfortunately, if you don't know what the rules of origin of the product is, a prime example is if you import lots of different products from around the world, then if you have a look at the rulings on the World Trade Organization website per your specific product, then it will give you the percentages for the rules of origin. One thing I will say, Tony, that if we've got a no deal, then rules of origin, basically we're looking at third country duty rates, so the MFN rates as such. However, if we do have a deal, then fingers crossed, built into that deal, you would be able to have long-term suppliers declarations, which is a sticking point currently from your suppliers in the European Union or from around the world, to prove that the goods are of preferential origin, whereby you as a business, you're exporting them products back to the EU, for example, where you could go to your local chamber, where you could produce the UK EU1 equivalent document, and for your goods going into the EU, thereby you'll be claiming preference on them goods. So we're waiting on the deal, so fingers crossed, Tony, we can have that deal, and everything will be in place and more hunky-dory than what it currently is. But unfortunately, if there's no deal, like I've said before, we are looking at duty and VAT.
So you may be very busy over Christmas and New Year, I suspect.
Yeah, very much so.
Paul, over to you for questions from the audience, please.
Thanks. Sorry to delay in the mic again. Does anybody have any questions for Andy or for Tony? Nope. I mean, if anybody does have any questions that they later on think of, feel free to email. We will be sending out an evaluation form with our contact details on at the end of the webinar. So please use that to ask any questions which you might think of. Also, as we come to the end of the EU transition, we do know there's a lot of uncertainty at the moment for companies, and we are here to provide support for you with any issues that you find coming up. We have different means of providing that support. So please don't hesitate to contact us if you do get any issues as we now come towards the end of the year. As a last chance I'll give now for any questions. Otherwise, I'm just going to give my thanks to both Andy and Tony for a very informative presentation this morning and discussion around end of EU transition. Just to say to everybody else attending, this is our last webinar before Christmas. We will be having a series of webinars early in the new year. We will be sending out an evaluation form with contact details. So if you could please complete that and return it back to us. And also be highlighting some of the other event webinars and our resources to assist you in that email. So if nobody else has got any questions, I will just thank Tony and Andy and to wish you all a Nadolig Llawen, Merry Christmas, and let's hope we have a better 2021. So thank you. Diolch yn fawr.